everyone. Good morning. Thanks for coming on this lovely Friday after a long weekend. I'm sure you guys all went out last night too, so congratulations for coming. We have a great panel today. We're talking about tokenizing real-world assets. I'll let my panelists introduce themselves and give a little bit of background on their projects. I myself am Tesa. Fight Club, nobody's probably heard of it. It's Bankless DAO's investment DAO, and it follows the #1 rule. We don't really talk about ourselves. But I also am the co-founder of Tsukimi Capital, a distressed fund investing in bankrupt crypto assets. So go ahead, Sid.
I'm Sid Powell. I'm the co-founder and CEO of Maple Finance. You can think of us as a capital market on chain. So I came from a banking background, and what we've tried to do is build a lending offering for institutional borrowers and lenders. We have offerings in the tokenized T-bill space, digital asset lending, so secured by Bitcoin and ETH, and then we also have a real-world asset lending offering which does tax credits. But we launched about 2021, and we've done about 2.2 billion in loans.
Hi, I'm Aaron from Goldfinch. I'm a senior credit manager at Goldfinch, so my life is very much in the real-world asset space, doing originations. I'm kind of the Asia coverage, have spent more than 20 years of my life here in Southeast Asia, doing deals with credit funds, including Lendlease here, as well as a direct deal more recently with Faz Financial. I come from also a TradFi background, private equity, private debt, and met our CIO at Goldfinch 12 years ago, feeling a little bit old now, at Goldman in the credit risk department.
Hi, everyone. I'm Timothy Louis, and I currently serve as a vice president in private capital markets at ADEX. So my background is in traditional finance as well. I started out in investment banking at UBS. So currently, my role at ADEX is it's quite similar to investment banking, where we onboard issuers and products. We originate and execute deals. We then distribute them to our investors on our platform. ADEX, if you guys don't know, it's an investment platform based in Singapore. We were founded in 2017, and we now boast investors from all around the world across 40 different countries. So what ADEX does is we kind of provide that access to fractionalized private market investments, and we're powered by blockchain technology. Happy to be here and happy to start the discussion.
Hey everyone, John Nahas, Vice President and Global Head of BD for Ava Labs. Ava Labs is the firm behind the supporting the growth of the Avalanche ecosystem. Avalanche, of course, is a prominent L1. So in my capacity, I oversee all the verticals of the BD team, from crypto natives such as DeFi, NFTs, gaming, wallets and exchanges, enterprises, and institutional and capital markets. So a big focus on real-world assets, what we call on-chain assets, across tokenization and everything in between. Previous to Ava Labs, I was founding team at a company called Token Vault that was acquired by Franklin Templeton and was the company that initially built the on-chain money market token. So I've been in startups my whole life and growing the Avalanche ecosystem.
Hey, I'm Claude, founder and CEO at Mimo Labs, building a protocol called Kuma Protocol. A little bit different from most people here. I do not come from traditional finance much. I'm going from crypto as it gets. So what we do is more focused on making the assets accessible in the most crypto way we can find. We turn real-world assets, or some we could call off-chain assets, into permissionless interest-bearing stablecoins. I mean, for a very lax definition of what a stablecoin is, because it's only stable relative to the value of the underlying asset. However, it's stable relative to the currency. If a debt in dollar would turn into a dollar stablecoin, a debt in euro into a euro stablecoin, and so on. And in this specific context of bringing institutions to DeFi, we're looking at both sides of the market, right? Like bringing credit from institution or selling directly these assets to institution. But our focus is really on the crypto side. So I guess we're going to have fun talking about different side of the equation.
Yeah, so we have a great diversified panel today. I'm going to start off with you, Claude. What have been some of the potential benefits and challenges that you've encountered while tokenizing assets on the blockchain?
I mean, it can be a very long list when we come to challenges. But simply, the challenges come from what you're trying to achieve. If you're really only trying to expose people to yield, you can really limit the amount of challenges you would have if you're trying to be as crypto friendly as possible to crypto natives. If you want to work with people on like L1 or L2s, like directly working with protocols, you want to integrate deep into the space, then you come up with quite a bunch of challenges. In our case, it was first regulatory and then technical. Regulatory as in, well, how exactly do you expose people to a form of yield based on stuff that they don't generally have access to without essentially committing like any form of illegal activities? And the second part is, how do you reconcile that with like an efficient technical solution that is like compliant with the standards that the entire industry have been like building for the last couple of years through DeFi, right? It's because it's one thing to be able to deposit USDC into something and hope for the best. It's better, we believe, to well have something movable that you can work. And this has led to technical challenges. I mean, interest-bearing token are fine when you have really like fixed type of interest, but if you want to have something a little bit more exotic, especially when we're talking about different form of real-world assets, you would have something floating, like floating rates and all that. If you really want to stay DeFi compliant and be compatible with most protocols, it starts to be technically challenging, and this has been a lot of work. But you know, like it's work. It's not impossible. We're here for that, right?
Did anybody else want to jump in there? Sid, Aaron?
Yeah, sure.
Yeah.
So there's opportunities and challenges.
Yep.
I'll start, a little bit more optimistic on the opportunities. I think the reason that I was really sold on joining Goldfinch and taking a decentralized approach to private credit is I used to work in this industry, and the amount of people that have to touch money before it gets to the people who actually use it is ridiculous. You have to go from LPs to the fundraisers, you have to pay your funds to administer all those, you charge borrowers a huge amount of money in order to do legal docs, you charge them upfront fees. And so the idea of decentralization is just let's cut all of that out and get money directly to the people who need it, right? And so I think that there is a massive need for disruption in the traditional finance system, and I think that's where crypto can really come in. And so from a Goldfinch perspective, we take normal retail as well as institutional investors, put them right in front of the deals, no fees charged. I mean, there's a 10% interest fee that's charged and put into the protocol to help continue building the protocol, but none of that is going towards paying my salary, right? So I think there's a huge benefit from taking a decentralized approach there, and that keeps me driven. I would say one of the biggest challenges we face, though, is you kind of have to meet the market where it's at. We went from 0 AUM to 100 million AUM in about a year. And a lot of that money is what I would call crypto kind of degen yield farming money. And so
Mercenary capital.
yeah. And so we get to the other side of that, and the product that we're offering is quite complex. It's private credit. It's illiquid. You're getting 3 to 6% extra yield on top of what you can get in public markets, but these crypto people, don't totally understand the product, and that's not their fault, right? And so one of the biggest challenges I think we have to address is educating the crypto market, meeting them at the level of financial product sophistication that they're ready to accept, and also bring on board the institutional capital who really understand this risk and can underwrite it. So I think we have to wait for another bull market, and at the same time also have to do the hard work of educating people about these assets so that everybody can participate in the way we want them to.
I want to agree with Aaron on a couple of things and highlight some things that I see at least at the L1 level or the technology level, right? At the base infrastructure. I think, of course, the benefits are there, right? There's trillions of dollars of assets. The life cycle or history of assets, analog, electronic, and we're trying to digitize the world's assets. That's Ava Labs' primary mission, is digitizing anything and making kind of Web3 become the transfer of value like Web2 was for the transfer of information. So the benefits, of course, near instant the settlement times, as opposed to T+1 to 5, which, just chokes liquidity and slows down things. Removing intermediaries, right? Lowering that cost of entry, letting people really have access to markets. We did something recently with KKR where we tokenized the fund. Normally, you'd have to be a qualified institutional buyer. You'd have to put up a minimum of $10 million. You can tokenize that, bring it down. There's so many benefits. I mean, all of us on this panel can talk about all the benefits. I think the hurdles, though, are still, to Aaron, your point, right? The people who are doing this stuff on chain are the people who do things on chain. And crypto people build crypto products for crypto users. When we're building traditional products or digitizing traditional products, you need those trillions of dollars and those asset allocators and people in the traditional finance world to get on chain. And until now, you just have the crypto natives in there, right? So they're always looking for the higher yield, the 10x, the 100x, and they're like kind of disappointed when they have a more traditional yield. So there's that disconnect between bringing people from the real world or traditional finance on chain. And I think that's at the stack, at the technology and the regulatory level, right? Because people in crypto want to build things that are not like in line with the existing regulatory frameworks. But what we see and what we see throughout time is, wallets matter. Who's going to be holding these wallets, right? And RIA is not going to hold the ledger, right, on behalf of their clients when he's a fiduciary and put it in a drawer somewhere. So you need custody, right? And custody providers, if you talk to whoever it may be, from BitGo to Coinbase to any of these quality custodians, right, look at this and they say, well, our minimum to custody is $1 million or 10 million or whatever. So if any of us want to own on-chain assets or tokenized securities, you need a custodian. And as an individual, my barrier to entry is not high enough to do that. So whether it's the wallet, the custody, the regulatory frameworks, all those things, we need to really fill in the gaps, because I think there's fantastic protocols, like all of you guys, right? You're doing fantastic work, but the access for what you're building to the normal user or the traditional asset allocator is still missing along, their regulatory concerns or their compliance concerns or just their operating processes.
Just before we move on to the next question, I think the way I think about it is it's kind of like early days of Netflix. And so you have a distribution advantage to doing this on chain, in that you don't, Netflix, unlike Blockbuster, didn't have to go and build a new branch. But like the early days, the constraining factor is it depended on people having an internet connection and the bandwidth. And that's kind of what's missing in the current environment and what we need to see develop more. So more access points to banking in the financial system, easier onboarding and on-ramping of funds and fiat into stables. That's how we ultimately transact on chain.
Those are very good challenges to tokenize assets, real world assets actually becoming more useful. John, in your case, what use cases have you seen? You're sitting at the top of Ava Labs. You're seeing all the different real world assets projects come in. Which ones do you think are really gonna, have been successful, other than the panelists here, of course? And what other use cases do you think, we're at the forefront and should go forward from there?
So, I mean, it kind of spans the entire arc of what's possible, right? But, we've seen success with tokenization. Like I mentioned, we did the tokenization of a KKR fund that normally most people would not have access to, right? So you're going to start to see more and more asset issuers kind of reach out for distribution, right? We're not there yet. It's getting there, but I think distribution's a huge thing. We launched a program at Avalanche. The foundation at Avalanche launched the Vista program. And the Vista program is $50 million put aside specifically to invest in real world assets, meaning things that are tokenized on chain on Avalanche. Because normally what you see with these things is when a tokenization happens, that first capital needs to come in so that everybody else feels comfortable doing it. In addition, we've launched, so Avalanche has this unique notion of things called subnets, which are either private permission chains or public chains, but ultimately all these chains can connect, right? So think of the old days, like your banks each had their own intranet and companies had their own intranets, and then the internet is when all of them connected. So that's kind of the vision at Avalanche, is with all these subnets. So we launched a process called Evergreen. And most recently, we launched a subnet called Spruce. And within Spruce, we have T. Rowe Price, Wellington, Wisdom Tree, and Cumberland all on there. And we have about 7 or 8 more FIs coming on board to provide them first on testnet with the sandbox where they can do things, right? Like where they can test out transactions, get used to doing operations on chain, and then eventually, hopefully in the near future, which we're working towards, is doing on-chain transactions. And what I think is exciting, of course, is, so you're looking at FX settlement, you're looking at interest rate swaps, you're looking at all these things. But to me, I think one of the largest things that's possible is really FX, right? The settlement times for FX are ridiculously slow. If you put an FX market on chain, you go from T plus whatever it is to T zero, right? You start to have a liquid 24/7, 365 FX market that unlocks global payments, peer-to-peer payments, remittances, and a million other things. And then Something else that's really exciting is kind of the phygital space. So we have a company on Avalanche called Legitimate that's doing clothing, lifestyle like applications, streetwear, all these things that have these little chips embedded in them, right? So you start to see, aside from like the securitization of things, but kind of, what NFTs used as real world, as certificates of authenticity, right? To actually, so if I go buy a Birkin bag for my wife one day, hopefully she'll be happy, and I want to sell it to you, right? Well, I have an NFT saying I own number one at 1465, it's orange or whatever, and now when I sell it to you, you have it, and you can track the lifestyle, and then companies can tag too. So there's just the whole life cycle of how we bring real world or off-chain assets on chain.
Yeah, this is, I mean, what you're bringing right now sounds like, of course, because I'm coming from engineering stuff like that, sounds like a lot of opportunities, also a lot of challenges. I mean, you're selling a Birkin bag, you sell the NFT, and then like somebody runs away with the Birkin bag, but you've sold the NFT. What do you do, right? It's one of the reasons why.
Then it's stolen.
Right? Yeah, exactly. I mean, it's, and you have something now. You need to be in a place where in a place where in the jurisdiction which recognizes the NFT as a certificate for the ownership. Like this is one of the reasons why every time we talk about tokenized real world assets, it used to be that everybody comes up with real estate first because it's the market everybody likes the most, and well, it's also where it's the most difficult to enforce this type of thing. It's I think, to go back to even the first question, like what are the opportunities and what are the challenges? It always comes in pair, like opportunity to open the market, fractionalize it, and limit the bar for ownership. Like you could, you take something that is $1 million, selling it to tokens worth $10 each, like with 18 decimals. Yeah, a lot of people can now buy, and then you have but will this be recognized as a proof of ownership and stuff like that? I think what this new market recently has brought in is that people moved from trying to go like from the pure like hard stuff like real estate and even like pure physical items to financial products, which are way easier to deal with from a regulatory perspective. And it's I think this is what we're experiencing right now, and even the fact that we can have these conversations is due to the kind of the bear market. Like people are expecting those 10x a little bit less. People are happy. The interest rates of everything is going up. Now those yields look even somewhat interesting for people in the crypto industry. So now they're coming to this and like, oh, maybe we could now tokenize those things. Like out of a sudden, 15% a year sounds a little bit more interesting, which nobody cares about in a bull run. And it's an industry that can, now start to maybe take off thanks to the current market conditions. It's the opportunity sometimes doesn't come from where we expect it. And in my opinion, this is like clearly one of the things that everybody in the room has been jumping on.
Yeah, I think you touched on a very good point on the intermediaries and the custody, because basically when you're tokenizing real world assets, you kind of need that third party intermediary to ensure that the asset exists, ascribe value to the asset. So at ADX, last year we listed a wine portfolio. So it's just like there are so many different things that what you have in the traditional finance world is very well utilized, because you kind of need that third party expertise to ascribe the value to, because these are real world assets at the end of the day. So I guess from a regulatory perspective, ADX has always been very kosher about things. We're MES regulated. So all these certain regulations and rules that we have to follow, I think it kind of gives new investors and traditional investors that sense of security that, what they're investing in is actually there. So.
And
go ahead.
Just really quickly, I'd like to come back to John's example about the FX markets. If anyone wants some alpha out here, I always tell people if I didn't work at Goldfinch, I would be doing FX on chain. Like a lot of the businesses that I work with are fintechs. It takes them literally a year to KYC with a bank. Then you have to pay lawyers to do all of the different agreements, ISDAs, CSAs. And then the spread that you're charged on these FX swaps is incredibly scammy. You ask for like 3 different quotes, you get quotes varying by 5%. And the reason for that is that you have to pay the salary and the bonus of the person who's giving you the quote. Why? But what's ridiculous is I can go on Bloomberg right now and know exactly what the price of a USD IDR 1-year future is. So what's the point of paying all this money, right? So I think there are so many financial products that are like this that are just ripe for disruption, where people have just been collecting fees just because nobody else is, creating a legitimate challenge to them.
Those are very excellent points. And from crypto side, we can always see the use cases for real world assets. Tim, I want to go back to you. What opportunities do you see for actual institutions to come in, and what does tokenized real world assets give to them?
Yeah, so at ADX, most of our clients are your traditional fund managers. So with fund managers, you have your typical long-dated. I mean, now they have delved into open-ended funds, but your typical long-dated typically ranges between 10 to 12 years, and that sort of fund terms are not really accessible to your man on the street. So at ADX, the spirit of ADX when our founders started this company is really trying to democratize traditionally hard to access financial products. So basically, having onboarding all these fund managers and tokenizing these products, we are able to fractionalize in much smaller ticket sizes, but also the kind of tokens and the exchange that we're running provides that sort of liquidity. And let's say, for very practical reasons, we're not talking about like short sellers or what have you. So it's like, if let's say you are a 60-year-old person who, passed away halfway through the investment life of your fund, you can quite easily, I mean, the executors of your will can quite easily liquidate that part of your investment, because we have an exchange that helps facilitate that. So there are very practical uses that these financial institutions can kind of tap onto our platform, tap onto our technology to really, open up alternative sources of capital.
I'm still not sure that the extra liquidity is what's driving adoption. Like, I know the thesis is supply side, we're going to tokenize funds, fractionalize them, and then everybody be able to buy smaller chunks, and so we capture that consumer surplus. What I've found, though, in how we've tried to approach it is there needs to be a job to be done, which is, either you want better liquidity or lower fees, return of your funds sooner, or more transparency. And so how we try and sell it is more at the primary issuance stage and going to either high net worth, so like private wealth type clients, or family offices, or smaller hedge funds. This is the thing, is we often find that the better customers are smaller, newer hedge funds, in the same way that the incumbents in other technology paradigm shifts, whether it was like electric vehicles or personal computing or the shift to mobile, weren't nimble enough to move. We've tried to just go to the people who are being started now to compete with them. So a smaller fund that was set up to do yield on chain is a better customer for us than the likes of the Franklin Templetons or the Apollos or the Ares, because for them, the unfortunate math is that it's too big a reputational risk for them to go into this space for a tiny amount of incremental revenue. Whereas for the new guys, it's the differentiation that sets them apart and helps them grow. And so like our current products are more marketed towards those guys so that they can get either a yield pickup, they can offer something different to their clients. And then I think other products would do well trying to then also go to LPs directly. Like, if we have the ability to offer these products easily with very low costs of distribution, you don't need to sell wholesale to a massive fund in order to pick up traction and volume. And so I think that's why I do think you'll see the fastest kind of disruptive adoption and traction taking place amongst smaller asset managers and newer asset managers.
I think we can add like something that is like a little bit different, like a different perspective on that, as in like another type of customer, another type of institutional customer that will benefit a lot from tokenization of real world assets. A couple of things that crypto has been very good at doing is creation of communities and creation of markets very quickly. Like you can create a market for pretty much anything by opening a pool, like seeding liquidity to it and adding incentives to it on the gauge, and doesn't necessarily need to have like anything gigantic, but essentially the tools that the industry have been building are very efficient at creating small markets, quick, and add liquidity. Now, if you find this from the perspective of somebody who wants to raise a form of debt, person would come to us and say, well, we can do two things. First, like we can sell some of our debt on the crypto market. We tokenize it, we put it into those DeFi pools. We add a little bit of yield to it to attract some people to ape into the pools. And in addition, like everybody who owns this debt becomes somewhat tied to us in the form of a community. So you can turn those people into customers. You can have like something that was very difficult to do in previous way of doing businesses and raising debt through banks would be like, well, now you can consider this as a new way to acquire customers. You can like decide that, well, those people will be paid by you because they will like have essentially access to your yield. And in addition to this, they have somehow like another link to your company, as instead of owning their product, they own your debt. And you can prop this market rather quickly by by just leveraging the DeFi tools. What I mean is that we have constructed all those things for essentially like tokens and protocols. And this whole infrastructure can now be used by companies to do something that nobody really had thought about. And I'm just giving you an idea in 5 minutes, but we can have found many, many more like this. And this only happened because now we can tokenize real world assets. So from a company perspective, we can think about better customer acquisition channels, like going to this, like without even having to go into customer surplus, like you were talking about, like even just going into a normal customer already existing. You can just like federate customer, go for customer acquisition, and have a different way of paid customer acquisition channels just through tokenizing your assets.
It's going to sound like I'm disagreeing with you, but that is just a transfer of wealth from the startup. And so what you're looking at is the company who comes and tokenizes something then has to pay out a bunch of its own equity effectively to acquire that customer. It's not necessarily a better customer acquisition channel.
Not saying that you have to tokenize your equity. It could be tokenizing some form of debt, and you don't.
Sorry, I mean the liquidity mining incentives.
Yeah.
Somebody bears that cost.
Of course, like somebody has to bear the cost. What I mean is that it's I mean, and the reason why I'm saying this is that because we've done this for a company recently, you can actually just through the fact that the protocols themselves are now trying to incentivize markets. What we had was just a multi-party deal where the DEX was incentivizing, the company was incentivizing a little bit through their yield, and then the platform, like the L1 itself, was incentivizing. You have something that would have cost you something different in the real world, but because you're in crypto and that people are still paying incentives, you can essentially benefit from the ecosystem itself to pay for your customer acquisition.
I think Claude touches on something, and I guess I will disagree with you a little bit on one thing. When we talk about this formation of communities, like I don't feel part of the community that owns Tesla stock, right? Like maybe I feel like I'm part of an Apple stock. Like I feel like community, particularly in crypto, is a fantastic thing, but it's really a bootstrapping mechanism to get technology adoption. And then we talk about incentives and boosting yield and all these things. Again, ways to get users, right? It's a bootstrapping mechanism, which just repeatedly says we haven't arrived yet, right? And the point of this, I think, this panel, right, and talking about institutions and onboarding institutions into DeFi is they are just simply not going to take a risk. To Sid's point, right? The smaller guys, the guys that are looking for an edge, they're the ones that are nimble that are going to try it, but they're not going to make that much more of a difference to tilt the big guys into this. And to the big guys, it all comes down to one thing that Sid also said. It's reputation, right? They can never take a chance on something that's okay today that might not be okay tomorrow.
That's true. I'm not disagreeing with this at all. I think I echo the point that Sid made earlier. Like the big guys will not take the risk, small guys would, and it's just a different way for them to either acquire capital or liquidity and additional. What I mean is that in addition to this, you will have access to community.
True, but back to the initial point, right? Like what brings onboards institutions into DeFi? Like, we're going to keep targeting smaller pools and smaller groups and keep going in circles, building crypto products for crypto users. Like, and it comes down to the reputational risk. And I think, look, I'm very obviously biased in favor of Avalanche, but even when you talk to L2s, right? L2s are coming up with privacy solutions or specific solutions for bringing assets on chain. You need a sandbox or you need an infrastructure that allows them to control their environment, right? That's kind of the path that we're looking for, right? You can't have an institution like a Franklin Templeton or like an Apollo do a transaction on chain where that transaction lives alongside a monkey JPEG or a DeFi transaction with an illicit actor that hasn't been KYC. You can't have shared block space on a single chain that's going to hold all the transactions of the world. It's just not going to happen.
But
So you
that's
need to
not
split it up.
necessarily that's not necessarily a problem of crypto itself. Like private chains, private pools have been a thing, and they're still a thing. So I think it doesn't come at odds. You can do those things and save the regulatory risk.
I love this discussion as the co-founder of Fight Club. I love it when people have disagreeing viewpoints. But before we get too far into an actual Fight Club, I just wanted to have each speaker kind of just summarize what your viewpoints are in real-world assets, and then we'll take open questions from the floor. So starting with you, Sid, because you're closest to me.
Just summarizing my views on.
Summarizing your views, yeah, how real-world assets work, how can we bring in institutions, any conclusion that you want to put in?
I think, as I've been kind of alluding to, I don't know that there's a problem with the technology. I also think, regulation is kind of something sort of outside what is in our control. What I try and focus on is jobs to be done. So it has to either be lower cost, better liquidity, or faster payback periods. But I think primarily what we're dealing with at the moment is actually more of a business development problem. We actually just need to bring in business development and capacity. So we need the number and volume of stablecoins to 10x from here. We need 10x more on ramps into crypto. Like if we want to do real world asset lending, I have to be able to get eventually fiat to one of the borrowers so that they can spend it. And so this is it's kind of like that's the oxygen in the room that real world assets lending needs to breathe. But I think we do have a real advantage when we start to highlight, that there are potentially less fees involved in doing real world asset lending. So ultimately, either the borrower is going to benefit from less interest, or the lenders are going to benefit from higher returns. And the fact that you have transparent real-time reporting is going to show up somewhere, either in lower cost or lower cost of capital, lower cost of operating. But this is what we try and highlight. Maple is at the moment definitely generally more focused on like business development, partnerships, and getting new lending deals done, rather than kind of tweaking the technology. And so that's what I always try and talk to, whether it's layer twos or other new folks entering the space, focus more on the business development side of it.
Yeah, I would say we really need to lean into the technology of the blockchain and let it speak for itself, right? The CEO of BlackRock has come out and says tokenization is the future, but who are they hiring? They are hiring engineers, because what is exciting about tokenization is that you're able to tokenize these assets and transfer these, rebalance portfolios very quickly, rather than kind of having to sign a million different documents in order to move this risk around. And so I think what we need to do is move away from saying, hey, crypto is sexy, you guys can get some like free tokens from our protocol, and actually just believe in the blockchain, right? And I would encourage all of you guys, we actually just launched a demo at DeFiForTheWorld.com where basically you can go in, write your email address, it links to a biometric, verification process. We create the wallet on the back end, pre-fund it with ETH. And as an individual, you don't even need to know that you're interacting with the blockchain. You don't even need to download MetaMask. And so work on the technology, and then eventually people will realize that using this technology makes rebalancing their portfolios a lot easier and also saves them money.
I think just to add to that, one of the points Aaron made is really important. So it's what Goldfinch has done really well is abstract away the unpleasant UX aspects, and so then it kind of you spend less time needing to educate folks on the blockchain, and it's more just a really pleasurable user experience, like abstracted wallet, easy interface.
Yeah, and we used to think like, minting a KYC, NFT, and downloading MetaMask, that's not that big of an ask. That's not true. Everybody is terrified. Those two steps are really scary for them. So you have to make this as simple as possible and, abstract away the crypto.
I think for ADX, our focus from the get-go has always been to be regulated, and because existing in Singapore, once you delve into tokens, and once the tokens are considered securities, you kind of fall into the regulatory hurdles and the regulatory obligations that you have to abide by. So in terms of the focus that ADX has been steered towards for the past few years, has always been to get that regulatory stamp. And with that regulatory stamp gives you kind of that credibility to kind of build your brand, build your reputation, and really like being able to bring very good products to our investors.
So I'll disagree with Sid on one thing, in the sense that it is about the tech. But I will agree with you that we are very small, right? We need liquidity. Everything needs a 10x. But I do think it's about the tech. And to Aaron's point, right, all these top banks and FIs are hiring engineers. Because what does that say? That says to me that up until this point, minus the BD work that we're doing, minus this point, we don't have a technology that solves their needs, right? Because we're still working in a paradigm where a single chain can handle all the world's transactions with an L2 or L3 or L4 until we're just going to keep adding layers of complexity as it like an inverted triangle, right? Like that's ultimately, I don't think the way it's going to work. You need separate systems for separate use cases that inevitably potentially can tie in together. Now this is separate chains via bridges, Avalanche subnets, via messaging protocols. You need a chain or an infrastructure that can handle securities, and you need other chains that are in the unregulated space, right? But you can't mix these two together, right? You can't take a security token and put it on Uniswap, because if you do that, whatever that's on has to be regulated, right? You need a chain that has a broker dealer, that has KYC, that has AML, that has all these compliance things necessary. So you can't mix the unregulated with the regulated unless the entire stack is regulated. And that's just up until this point been missing, right? Like the key connecting points. Everyone comes up with a great idea, or let's limit it at the application layer, but then that application can't talk to any other application because those other ones aren't vetted.
So I think that what we're kind of missing here is also that there's progress in technology. There's also progress in regulation. People who are behind AML policies and all that, behind AML regulation. We talk to regulators a lot. I think everybody in this panel, I assume, talks to regulators on the regular, and we're helping them like build frameworks that understand us. Like it's not only about us bending to whatever they're doing, it's also on the other side. And I think we're progressing the right way. Like in my opinion, like we're not regressing, we're going pretty good. So yeah.
I would agree with you in this side of the world. I was in Korea last week. We're here in Singapore this week. Asia's leading the way. Even Europe with Micah is leading the way. The US is going backwards and in the wrong direction. They're actually not even going backwards. They're not even going in any direction. They're just doing nothing.
I would say I always joke with my compliance head of compliance saying like you have to be innovative, and it's just like very different.
Yeah,
but I think the progress that's going to start to happen in Hong Kong and Singapore, that's continuing in Singapore, but now with Hong Kong and even the EU is going to force the US.
Yeah, I mean,
to do it, or else it's just everything's just going to move.
We're seeing this, like a lot of the crypto world has moved into everything except for the US, everything like banning US residents for a lot of apps and all that. I mean, this is what you say is true. I'm saying that it's also, I think the tech is also somewhat important in the fact that crypto has been pretty good at, especially DeFi, has been pretty good at building what people tend to call money Legos. And that's one of the things where everybody's somewhat right. Like you have somebody that say, don't focus about the tech, focus on the BD, but you have some people that focus on the tech, and they're both right. Because if some people focus on BD, bring something, some of other people focus on the tech, protocol A is going to use protocol B, is going to bring the money in, and everything flows like that. And it has been the way it worked for everything in DeFi so far. I see no reason why it would not work like that for DeFi. And it could also have, I mean, permission DeFi could be a thing, like back to your point, and it would still be different protocols where the money could go through. They would just be KYC. It would just have AML enforcement. There's no reason why you can't do this through smart contracts. I just think like we have the possibility of creating tech that embraces that, just like really that matches the problem that we have to solve. As long as regulation keep progressing, and again, as long as we're on the right side of the world, I think we're good. It's I see the space as evolving more towards not as a pure replication of the original traditional finance world, but more as something slightly different, where money would move differently. Like it would be easier for smaller actors at first. the way big actors will embrace it is not defined yet. But for smaller actors, like talking from smaller institutions bringing money in, small institutions raising, creation of secondary markets directly on chain, or even smaller hedge funds like you were talking about, like looking for different ways to generate their yield, would be. I mean, we'll see that first, and the way it's going to grow is still not defined yet. Like, where are we going to onboard the gigantic guys? I mean, crypto is not attracting them yet, but there's already a lot of money in crypto that still needs better approaches than just USDC.
Well, that wraps up our time. Unless we have additional time to ask questions, we can't. Okay, who has a question? Since you're right there and I see you. Yeah, go ahead.
Thanks. It's really nice to see like a product focus here, and as Sid already mentioned, the JTBD framework. Basically, if we have a look at that, well, institutions have a simple job to do. They have to basically allocate funds and get yield on that. And basically, we're competing with TradFi here in a way, and we have a lot of obstacles which basically prevent from switching. We have the regulation, which have been mentioned, and that's massive, and people mostly talk about this in the first place. We have technology and UI UX, which you already mentioned also too. And we've briefly touched on liquidity, but I believe that's still a very important topic, because when talking to funds, they often say, I'd love to deploy funds into DeFi, and I'm enthusiastic, but I can't do it. I mean, the liquidity is so limited. I mean, it's like more than $1 million or 5, like I can do nothing, like even if I'd love to and I want to do it. And the question is, what do you think will be the driver of this liquidity inflow? Will it be the retail? Will it be the small players? Will it be the institutions? Will it be even corporates? Well, that's less likely in my opinion, but what's your take on that? What's going to drive this stumbling block?
I mean, there's a couple. Sorry, I just start.
That's all right.
Yeah.
I was going to say, I think it's going to be retail first. Like, I think all major tech adoptions and kind of capital formation shifts begin with retail. Like, if you look at railroads 150 years ago, if we look at just the last two, like the ICO boom, the yield farming DeFi summer boom, both of those were kind of retail driven. I think the next one, I don't know what the catalyst will be, but it'll probably be retail driven. Retail signals profitability, and then that drives in institutions as late adopters. BlackRock was not the first to pick, a Bitcoin ETF.
I think it could be coming from something like in the middle. Like, it's a lot of the users of DeFi, around DeFi Summer and all that, were not the direct retail, but actually the aggregate platforms that aggregate retail, ask them to pull their money somewhere, and then those guys use DeFi. So you have this type of intermediary player that were not like fully institutional, fully retail, because it was still like a retail money with some form of like a middle layer inside of of centralized companies. Like essentially those would be wallets or earn programs of exchanges and stuff like that. That were ultimately a lot of users of DeFi. If you look at the wallet using like the protocols are in 2020, you'll see a lot of larger wallets that were diving into protocols. So it could be coming from there. It could also be that, I mean, if by liquidity we can mean a couple things, but if somebody is deploying a lot of money onto DeFi and they're looking for liquidity, like, do they mean that they want liquidity in order to exit the position? In this case, it would need to be somewhat like permissionless or permissioned with a pool of other permissioned actors, so you don't get to trade with a monkey like you were talking a little bit earlier. It's more like the platforms for that do not necessarily exist yet. So before we can even talk about bringing liquidity to those people, we need to see, like, will there be a platform for them to trade those real world assets with liquidity? We're working on things like that, but this is not big yet. Most of the real world asset platform do not really direct towards liquidity, but more for direct yield exposure.
John, really quick, your answer.
Real quick, Sid's right about this. Retail drives adoption. The status quo will not change from the incumbents unless it has to, right? They're very comfortable doing what they're doing. Retail always does it. Retail's interest in this space is what's moved these asset managers into this space. But, I would be remiss, we're at the Stablecoin Summit, to not mention that on the retail side and on the liquidity side, we need more stablecoins. And, with all my respect to my good friends at Circle, with USDC and EuroC and our buddies at Tether, we need, StraightX is doing this, Singapore dollar, Swiss franc, Japanese yen. We need to digitize all these currencies, unlock that liquidity, or else someone in Japan to get to USDC or to get into Tether, we're creating more and more barriers. So you need to digitize, you need I go back to the FX thing, right? You need more stable coins and more currencies to get digitized on chain, and then you can open up the liquidity barriers and really go forward.
I think it's not as easy. Sorry, I keep jumping around.
I'm sorry, Claude, we're going to cut you off. One last guy, this guy at the end, because I can see him, and give, when your answers, just one sentence answers. So guy at the back, because you've been raising your hand for a while.
Sorry.
Or you, a guy with the microphone.
Sorry,
Never mind, you have the microphone.
Sorry about that. My name is Satish. The problem today, if you look at smallholder farmers across the world, there's a $240 billion lending gap. And if you look at the tangible assets, which is the farmland, which is tangible, it won't move. And the intangible is obviously the produce that comes out, right? So what are the views on tokenizing the tangible assets, which is the farmland, so that they can liquidate and get loans at a cheaper price? And look at the produce that comes in the next 6 months, because in developing countries, we've been doing a lot of research. My background is MIT research, and I've been running a company for the last 7 years in this space. I want to ask all of you, what is the view from institutional investment to be able to help farmers across the world? Thank you.
So your question is, what can institutions do to help farmers collateralize their land?
Absolutely, land and also produce, which is intangible.
Yeah, and then their products. One sentence answers across the board.
I would say it's very difficult for individual lenders to enforce against hard assets, even if those assets have value. I think you need a company that sits in the middle, like a fintech, that's able to really underwrite this risk, enforce on your behalf. And so you do need that intermediary that helps get people comfortable, because that direct risk is a little bit too complicated for people to understand.
Depends on the region. So it's largely dependent on how good the judicial system is going to be at resolving any disputes. Very different prospect doing that in, say, the US or Europe versus, Nigeria or some other sort of newly developing market.
I'll just say it's difficult to do it on an individual basis. Something we're proud of at Avalanche, we're supporting Lemonade. It's a global insurtech provider. What they're doing is they have the Lemonade Crypto Climate Insurance Program. So small users, small farmland owners can insure their crops, insure their yield, insure that whatever they generate for a very small amount. So we just had someone in Kenya do this for 27 cents for their entire year, because insurance usually is so expensive, but by digitizing, removing all the barriers in between, they can get an insurance policy for $10,000 to protect their crop and their land for like less than $1. So that's something that they're rolling out in Africa, then Southeast Asia, and growing globally.
All right, we have time for one last question from the gentleman behind here.
There he is.
Hey guys, thanks so much for making the time. It was a really wonderful discussion. There was an interesting point made around KYC and compliance being solved at the chain level. Why do you guys think that it is important to do it at the chain level, considering there's so much discrepancy in the rulings and regulations and how KYC and compliance rules are set around the world? So why not why does it have to be at the chain level?
So the question, just to summarize, is why is KYC being done on the blockchain level versus being off-chain?
During the panel, there was a recommendation that an L1 chain or a chain that is compliant would unlock institutional investing or tokenization. The question is, why does it have to be at the chain level? Why can't it be?
I got the question. I disagree. I don't think KYC should be at a chain level. I don't like the idea that you have one arbiter of who can transact in finance. Like we saw that was abused in Canada. We saw it was abused recently in Britain with Nigel Farage. Disagree with his politics or not, you shouldn't have one person be able to, one decider be able to freeze somebody out of transacting in finance. So I disagree.
I definitely agree. Because for now, you have to take a step back and look at the thesis that we have at Avalanche, is that there's not going to be one chain. So there's not an institutional chain that only institutions work on and a public chain. We believe in a network of chains that are interconnected, that a private chain can, if it so chooses, connect to a public chain if it wants to, or connect to another private chain. So you have a network of blockchains working together, kind of like the internet did, right? Between closed intranets and et cetera, et cetera. The reason we think this is because you need different sandboxes for different use cases. And if you try and put it all on one, it's not going to work. And from our experience, this is what the participants that we work with are telling us, right? It's not my opinion. It's T. Rowe Price and Wellington and Cumberland and Wisdom Tree and the 7 or 8 other people that we have joining this private permission chain that we're building that inevitably will connect to other chains and other use cases, particularly the Avalanche C chain, to pull in stable coins and liquidity, right? So they decide who they can interact with and open up with. And that's just what institutions are going to want, right? They're not going to come in at the very extreme. They're going to come in where they're comfortable and then loosen up as time goes by.
I think this is an educational problem because from a technical perspective, there should not be much of a difference. And from private chains, you could even, if your chain is really truly private, you can even run into like security issues where you have 3 validators being the same guy because they run by the same company versus public chains, which tend to be like just more secure. So I would generally like be in favor of educating people in the space for them to understand that they can reach the security needs or reach their needs even by doing KYC on the protocol level. And this is what we've seen so far. Like people have been, like a lot of very large companies have onboarded directly on Ethereum, but just on protocols where you could just not use them without like being KYC'd. Like this is something that is happening, and that's, I mean, a lot of people in the panel already run some of these permission protocols, and institutions are onboarding. I think like it is one option, and there will be multiple options. But the reason why you can put customers in A or B will be more based on education, in my opinion, because they don't understand their risk. So everything private sounds good to them until they realize that, well, maybe by going everything private, they take another risk. And the more they will understand the risk, the better we will be. But I'm not sure there's the one answer fits all of if it's private chain, everything is great. If it's a private protocol, everything is great.
But up until this point, there's been a misconception that a private chain is a private chain and lives in a vacuum. A private chain, or at least an Avalanche subnet, is a private chain that lives on a public architecture. So you're still part of the public network that is decentralized with 1,400 validators and growing, et cetera, right?
I know, I have
it's not a separate. I know, but like the fundamental way that we look at this technology needs to change, right? I think, in my opinion, to get to that next level. Because
that's education again. Yeah. So we don't disagree. I think it's just like the thing can work on the KYC as done at different levels. What cannot work is a fully permissionless everything from zero. As we've seen, it just didn't work. A lot of people have tried. It just didn't work, and regulators will not be very happy with the absolute absence of AML. But, well, it's fully on-chain is not necessary for the growth in the space, I believe. But will it help? Yeah, probably.
Thanks, guys.
Yeah.
Thanks, Sid.
Thanks, everyone. Appreciate your time.
Thank you.